What are levels in trading? What is a support level? What is a resistance level? And how do they differ from each other? Is it possible to trade using this knowledge, using these support and resistance levels? How can you learn to spot them on the chart, and how do you draw them correctly so that the line isn't just an amorphous stripe on the chart, but actually works, so that you could at least theoretically trade off that level and make some profit? In this video, as a practicing trader who's been in the market for a long time, I'll show you a few life hacks or maybe some practical tips and trading patterns that you can use in your own trading system, whether you already have one or, even if you don't, you'll be able to develop and use one after watching my technical analysis course, which I'll be publishing on YouTube. And to make sure you don't miss these videos, hit the bell, like, and the subscribe button. Thanks in advance. My name is Maxim. This is the channel Thinking Out Loud. Let's dive into understanding levels. And since this is a practical lesson, let me first show you right away what a level actually is and how it works in practice. And then we'll dig a little deeper into the theory. So, what is a level? A level is a line that's simply drawn through two or more peaks. Look here, here's one peak, here's a second, and here's a third. I can draw a line through them like this. That will be a level. And, for example, from this same peak, I can draw at least one more level through this other peak, right? Both of these will be levels. In fact, I often draw two levels like this and consider the whole area between them as the level zone. Or, for example, I also use levels like this based on the wicks, one level by the wicks and a second level by the candle bodies, basically ignoring these wicks. And I use this in this space as levels or zones of support and resistance. Here comes the first life hack. You need to understand that, although a level is usually shown as just a line on the chart, in reality, it's a zone that will either support the price or resist its movement. This is an important life hack, trust me. Well, let's dig deeper. Do they actually work? So, we've already drawn 4 lines. We've marked support by the candle wicks and by the candle bodies, and for resistance, we've drawn one through one peak by the wicks, and another resistance through the second peak. Let's figure out what makes these support lines at the bottom different from the resistance lines. Spoiler, there's absolutely no difference between them. There's absolutely no difference between support and resistance. It's simply about how the price relates to that line. If the price is below the line and the line seems to be preventing the price from breaking upwards, then that's a resistance line. If the level is below the price and kind of supports it from falling down, that's a support level. That's all there is to it. That's why I always draw them in the same color, because there's really no difference between these levels. Now let's take a look, scroll through the charts a bit, and see whether these levels actually work or not. See? It's like the price is trying to slip through this level, but it keeps getting bought up again and again. That's exactly how a support level works. At the same time, if you look a bit closer, you'll notice that the level has been pierced, yes. So, it gets pierced, but it keeps getting bought up every time. So it's not exactly a wow, super precise line that you absolutely can't cross. It's more like a zone where the price will be supported, and, accordingly, from above it's a zone where the price will face resistance. Let's keep scrolling and see what happens next. Here, the price broke through, and now the support zone, which is marked by these two lines, becomes the resistance zone. So if the price does move past this zone, the support automatically turns into resistance, because now it's above the price and, just like these other levels, will resist the price. And what happens next? What happens is this support has turned into resistance, plus we also have this resistance here. So, this area is, let's say, a stronger resistance zone than, for example, right here. And as we can see, the price predictably bounced back, and it bounced by quite a large percentage, 17%. I've turned off the rewind, and now we can see, here it is, our level, you see? Even if we extend it further, it will act as resistance here once again, then it will be broken, and after that, it will start acting as support. And obviously, we can also draw another support line here, which, as you can see, will later on also support our prices. And just so you understand the scale of the situation, each of these candles here represents 1 week, and from this peak to this one, it's a year. So over the course of a year, 1, 2, 3 times, and here, 1, 2, well, roughly 3 times, these levels have played out. And then, after another half a year, they come into play again. I just tried to clearly demonstrate to you precisely why these particular lines are drawn on the chart, because they still work effectively even a full year or a year and a half later. In other words, solid, strong levels might come in handy for you in a year, 2 years, or sometimes even 4 if the market is more or less stable. If you want to understand why and how all of this works, check out the previous video if you haven't seen it yet. There, I talked about 5 mistakes beginner traders make and, in general, why technical analysis actually works. But for now, let's go back to the chart, and I'll show you what kinds of levels there are and how to draw them. After that, we'll get into some life hacks for drawing them and trading around levels, either bouncing off them or trading breakouts of support and resistance. Basically, there are only two types of levels. They're just horizontal lines. Here on the left, on the tool panel, you can click on this little arrow, horizontal line, Alt-H. This tool simply marks a certain price, basically just a price point. Usually, this tool is used on very large time frames, like 1 week, for example. Like right now, each candlestick represents 1 week. So this is a huge span of time, from 1998 to 2015. It's on these kinds of time frames that these levels work best, and usually, at the very least, they're used to measure the all-time high. That is, the maximum price ADH, all-time high, the highest price at the moment. That's how you set the level. And let's also set at least the minimum price, so we know that the assets were at this price. Additionally, you can mark any other price you want on the chart. But on this particular chart, I wouldn't mark too many lines, because you can see that no matter where I draw a line, it seems like the slanted levels would work better, right? That happens, and it's actually completely normal, because assets can be very different. Some assets respond really well to price levels, like Norilsk nickel, for example. But this is specifically Lukoil. It reacts well to slanted levels. You can see that here, right? Here, I've already shown you this segment. And this segment here, you can mark resistance zones with slanted lines like this. And here's an obvious support, right? You can draw a parallel line, then another one, and yet another parallel line. So, overall, you can see that for this particular asset, it's better to use diagonal levels. And here's another life hack for you. If you see that straight lines fit an asset better, use straight lines, but place them at round numbers. So, for example, if your level comes out to something like 3,251, set it at either 3,250 or even just 3,200, depending on the asset's volatility. And, probably, you should use these major, key price levels that clearly mark a certain significant price point on the weekly or daily timeframe charts, because such important levels will consistently work out more often and prove to be more reliable than levels found on the shorter hourly charts. Break time equals 0.5s/. On the hourly or 4-hour chart, or even lower for some reason, if you go there looking for levels, first of all, levels below the 1-hour time frame practically won't work at all, except maybe as part of some chart patterns. And secondly, on the 1-hour or 4-hour time frames, where you can probably also look for some levels, slanted, trend, lines will work out much better than straight horizontal lines. So pay attention to the time frames, this is important. And let me repeat once again, as I said in the previous video, if you don't see any obvious levels, don't make them up. Don't invent levels, you should only draw the most obvious ones. So obvious that even a blind person would notice them. That means we always mark the all-time high and all-time low. And further, if you don't see a really obvious level, if you drag that line up and down and just can't find a good level where the price clearly reacts, then it simply doesn't exist. That's it, just draw some trend lines, and they'll work just as well. Many assets have worked perfectly with trend lines for years. Let's go, I'll show you. Here's another quick life hack. For convenience when drawing, I often zoom the chart out really far, making it very small. It might look like it's just a millimeter wide, but it's actually pretty convenient for drawing levels on it. Let's try it like this. Look, a level is 2 points or more. I can even draw an all-time low trend line right here, connecting this point and this one. And this is the kind of line we end up with, right? It touches once, twice, 3 times, almost touched here, 4 times. So, I could have drawn it, say, back in 98 or 2001, and it would have worked out in 2008, 10 years later, just so you know. Just so you know, right? So, the scale of support and resistance levels that will actually work out. Here's another level. I can draw a resistance line through these 2 peaks, right? And I can also try to make another fan-shaped resistance like this. I often use this kind of fan resistance, or a double resistance level like this, or sometimes a double support when it appears on the chart. Because in reality, a support or resistance level, it's not just lines, it's more of a zone, right? But when we draw on the weekly chart, the lines will still work out quite precisely. And let's try drawing another support line along some of these points. Let's zoom in a bit, and I'll show you the actual technique, how to draw these levels, basically. We take this tool, either a ray, a straight line, or a segment, whatever you prefer, place it at some lower point, the lowest peak of something, and think about where we can extend it next. Can we extend it through this peak? We can. This is the kind of level we get, but it's already been broken through a long time ago, so I don't really see much point in drawing it. Let's take the next peak. Can we draw a level through it? We can. As you can see, it worked out and acted as both support and resistance. Then, in the same way, we can draw a level through this peak, through these peaks, and it will probably work out somewhere as well. But what's the point of doing all that if all those levels have already been broken, and the only peak that hasn't been broken is this one, right? And, roughly speaking, also this one, and this one. So here we have about 4 peaks where we can use them as reference points and draw a straight line. That's exactly what I did, actually. This is how we draw it. It's a pretty simple way to draw these lines. At the same time, if you're unsure, if you have, say, a messy chart with shadows, with lots of wicks and candles, with these kinds of spikes that throw you off, you can try switching here from candles mode to line mode, and you'll get a clear line. And sometimes, with this kind of chart, this kind of graphical analysis, it's just easier for some people to draw a line or spot a pattern. Especially when we start looking for patterns together. It's especially good for finding triangles this way. I'll definitely make a video about them too, so make sure to subscribe to this channel and hit the bell so you don't miss anything. I'll switch the candles back on and show you. Look, we finished drawing these lines back in April 2015. 2015, now it's 2025. 10 years ago. Let's take a look. I'll turn on the replay now, and we'll see, did these levels work out for us anywhere? And look here, the level is working, here it's being broken through, here it works again, here too, almost here it works, and here as well. So, basically, these lines work, guys, even after 10 years, especially if you found them on a higher time frame, like the weekly or daily charts. Let's sum up a bit before we start turning all this into trading. Let's go over some interim conclusions. First, support and resistance levels work best on higher time frames. That means daily and weekly charts. Second, they can work even decades later. In other words, properly drawn support and resistance levels on the weekly time frame can still be relevant and worth paying attention to even 10 years later. That's why I suggest marking them with a different color. I'll show you how in a moment. The lines I draw on the weekly chart, I usually make thicker and highlight them with some kind of warning color. So, the idea is that I develop an understanding that if I come across this level or see it on any time frame, say, when I'm trading on the hourly or 15-minute chart, I should really be wary of it. That's why I usually make them bold, like, say, 3 pixels thick, and they're usually red, or some kind of red, pink, or magenta color. So, I mark up the weekly chart, the weekly time frame, with these thick lines. By the way, to change the color of a line, you just need to click on it, and a window with its properties will pop up. There, you can choose the thickness and color. Nothing complicated about it. I'm sure you'll figure it out. Another tip right away, start marking up your chart on the weekly time frame. In other words, don't get bogged down. There's no need for all those lines, trying to figure things out on the 15-minute chart, trying to spot something. First of all, those lines don't work there. They just get broken through, up and down, in any direction. And secondly, your chart will end up looking really messy. Of course, when you're trading, you look for patterns and draw them even on the 15-minute, 1-hour, and 4-hour charts. And those will work. I'll show you, and I'll make separate lessons about chart patterns. How does it work? How do you trade it? But when you're just starting out, figuring out these levels, draw them first on the weekly charts, and then add something on the daily time frame if it's really necessary. Or maybe, in general, just stick to the bold levels from the rough weekly time frame. Those are the ones you really need to watch out for, especially when the price is approaching them. That's when you need to be careful. And you need to see this very clearly on the chart, because right now I'm showing you a compressed drawing like this, yeah. But in reality, when you're trading, you don't see a picture like that. Now I'll show you what changing the scale means. Look, it might seem to you that we've drawn a ton of lines here, a ton of levels. Let's also mark the new all-time high, just so we know, right? And, I don't know, maybe somewhere around here, let's see if there's another level. No, there's nothing here. Right here, I would mark this price. Again, look, I ended up with the price 5,997. So the actual level would be 6. Well, damn, I can't set it that precisely. I'll just remember that the real level is 6004 Lukoil. And there's obviously some kind of level here too, right? There's some resistance here, and then there's also this kind of, some sort of, like, another resistance here, right? Now let's go to the time frame where people look at 4-hour charts. We don't see anything at all. Basically, we just see these lines up top. And if we switch to the 1-hour chart, we won't see anything at all. And here, as you can see, there are different levels at play again. They're still the same. Look, we've switched to the 1-hour time frame from the weekly. So now each candlestick represents just 1 hour. And of course, it doesn't make sense to draw such thick lines here. I draw much thinner ones, but the levels still work here. Because if we, right here on the chart, we could have drawn a level through these peaks, just like this, drawn it through the empty space, and as you can see, it would have given us a chance to get our bearings and make some money, or at least try to open some kind of long trade with a stop like this. A stop like this. And here, with a 1 to 2.5 profit ratio, basically, you could have made some money on a little triangle on the 1-hour chart. Of course, for that you need to know what a triangle is and how to use levels in practice. But in principle, it's definitely possible. So let's start figuring this out together, so we don't make this video too long. But how are levels actually traded? And the way I just showed you, in reality, it's pretty much impossible to trade a level like that. I just drew that picture randomly, off the cuff. You won't be able to do it like that. Not because you're, dumb or anything like that, but because it's easy when we can see the whole pattern already formed. But when we can't see it, we don't know whether the level will break or bounce off it. That's why, in reality, you need to trade differently. Well, if you actually want to make a profit, of course, you need to trade either on the breakout or the rebound from the level. Basically, from our support or resistance, to be precise. And this action needs to be confirmed. In other words, you shouldn't be guessing. If you're just guessing, then it's basically like poker or any other gambling game. If you turn trading into gambling, you're going to lose money. But if you want to make money, you always need to know where your risk is. You need to control your risk and you need to control your profit. Honestly, risk management probably should have been the very first lesson I recorded, but it's really hard to explain risk management to you before you even start to understand how trades are opened or at least have some kind of trading system worked out in your head. And later, I will insist that the most important lesson in this entire technical analysis course is risk management. Also, keep in mind, I'm not giving financial advice, I'm just showing you how all of this works. This video is made to teach you and to show you, in general, how all of this works and how you can use it to your advantage. But you are responsible for your own money, I'm not forcing anything on you. And on that cheerful note, let me show you what a proper trade should actually look like, using support and resistance levels. Basically, it's not that important. But how you can use them to your advantage, to make money, and to keep the process under control. In other words, actual trading. Trading is always a controlled process, not just, damn, I feel like it, I swear, it's going to turn around. So, let's break down the trade I showed you. Why is it impossible? Because entering right here, on this candle, on this spike to the level, is just too aggressive of an entry. Yeah, I set the stop loss way down here, under these very levels. Basically, just so that this trade would at least have some chance of survival. And even then, it was still a very aggressive. I kind of intuitively put my stop loss just below the levels. But it's still a very aggressive move. And that's not the right approach from a trading perspective, especially for beginner traders. In real life, you should enter after a bounce off the level. So for us, that would have been a good entry point somewhere around here. Let me zoom in a bit more so it's clear and visible. Since each of our candles represents 1 hour, we saw that when we tried to break through the level, the wick was bought up, then we tried to break through the level again, and once more we couldn't close below the level. The third time we broke through, we bounced back. And here, on the fourth candle, we have a kind of moral, well-founded right to enter, because we've received at least some small, weak confirmation. And then we have the right to set our stop loss, because it goes right here, under the low, under the base, right. And the take profit should be at least 2 stop losses away, or even better, 2.5. So, accordingly, we take these 2 stop losses somewhere around here, the risk-reward ratio is 2.5 even, and we pull it. Here, we've gotten our profit. This is how I showed you a more or less proper way to enter. Now I'll show you how you really should enter. A little life hack from experience. And by the way, I didn't come up with all this, Mr. Elder did, Alexander Elder. This is the triple screen system. These levels, all of this works pretty well with the triple screen system. And to use this, to make a good, high-quality entry, you need to understand what timeframes are and what a reversal pattern is. You don't know about them yet, so for now I'll just find some spot and show you what it actually looks like. And after you watch another 4 or 5 lessons, you'll be quite able to find such a spot on your own. For this, let's delete all our drawings. I'll just show you how to do it from the very beginning. We delete all our drawings and, well, whatever, just so we don't have to look for a new situation. We'll take the same situation as before, the one I already showed you. Here we have a 1-hour chart, and where did we enter? Somewhere around here, right? Okay, let's cut it off at this candle, as if we can't see anything beyond this point. Yes, we know we're going to make a profit. Of course, that's not entirely fair, but whatever. After all, this is an educational video, not a trading one. We'll draw it out, so, on the hourly chart, we've decided that we're going to look for some levels on the hourly time frame to trade intraday. If we wanted to trade patterns on the hourly chart, we would have to look for them on the 4-hour chart. So, let's quickly draw it out. Here we've got a peak, here's another peak, and here as well, we've got a peak. And here, too, there's kind of a peak. And probably, if we try to draw a parallel line, you see, it's exactly what I showed on the higher time frame, on the weekly chart, parallel levels, just the same. Pretty decent. So, we can see that there's some kind of interaction zone, right? We see that the price touched this action, or interaction, zone once again and bounced off. Well, theoretically, we might have a chance to trade this situation. What do we need to do to trade it? We need to switch to a time frame that's 4 times smaller. So, Alexander Elder suggested using a time frame that's 4 times smaller. So right now we're on the 1 hour chart. We switch to 15 minutes. See that? And on the 15-minute chart, we can see the sharp drop in price. At the same time, look, even according to the RSI, it's going into oversold territory. Yes, of course, I'll make a video about RSI and oversold conditions as well. But for now, just take my word for it, this is a small reversal signal. On the daily time frame, this would be a strong signal, but since we're looking at 15 minutes, it's just a minor one. And here, we start looking for a justified entry point. So either we try to enter right now, since we've seen a bounce, or let's say we skipped ahead a bit and missed that bounce, and now we see a correction happening and the level being tested one more time. At this point, we can already expect the price to bounce, and we can anticipate that the price will aim for this line once again, or, for example, maybe we'll draw another additional line on the 15-minute chart leading to this line. So, after all, we have some small price reference point, and, roughly speaking, we can see that the level is being defended somehow, and it has worked twice already. And another very important thing, the RSI has already started to turn around. In other words, we can see that the RSI is picking up momentum, meaning the market is being bought up. If we open a trade here like this, we'll have a justified stop loss below the levels. Moreover, you can set it aggressively right under these levels, or here, under the second level, depending, roughly speaking, on your risk profile and what you can count on. So with a stop like this, we can't really hope for much. Well, many like this, we can probably trade something like 250, 250. I see, here the risk-reward ratio is 245, 247, 250. So, that's the kind of trade we can work with. And if I turn off the replay, we'll see that, first of all, this level here was almost respected, right? The price was fluctuating around it, and it actually played out much later than I expected, but it did work out in the end. That's roughly how you can use levels in trading. Yeah, drawing levels below the daily time frame is kind of questionable, but in the stock market, even the hourly and 4-hour levels work pretty well. But you still need to look for entries on a time frame that's 4 times lower. So if you're drawing levels on the 4-hour chart, you should look for entries on the 1-hour chart. If you're drawing them on the hourly chart, then look for entries on the 15-minute chart. The higher the time frame, the greater the chance that the level will work out, but signals will appear less often. That's it. See you in the next videos. If something isn't clear or you want me to cover a specific topic, write in the comments. I'll be happy to answer.